Hello everyone, this is Ryan Mallory for SharePlanner.com. Today is January 2nd, 2014. It is that moment where last year's trading does not matter anymore. And this year's trading is, of course, all that we're going to be focused on. If you had a great year last year, great, fantastic. But guess what? As of January 2nd at 9:30 a.m. Eastern Time, it doesn't matter anymore. And why is that? Because the market is a what have you done lately type of environment. Last year's gains, it might be great, but like you always see on all those brokerage commercials and mutual funds commercials, it's not indicative of next year's results. Just because you might have made 20 or 30% last year doesn't mean that you are going to automatically make 20 or 30% this year. So it's you got to do the same thing that you did last year that made you successful and do it again this year. You have to repeat the process. You have to stay disciplined. You have to stay on course. You have to stay focused. You have to stay committed, and you got to stay dedicated. So last year, Splash Zone was a great vehicle for a lot of people. All the subs were able to do very well off of it. This year, though, I have to repeat what I just did last year for subscribers and for myself as well, and continue to manage risk, continue to look for setups that provide uh, low risk scenarios with high reward outcomes, and that's what 2014 is all about. It's the same thing that 2013 is about. Of course, there's going to be lessons that I've learned from 2013 that I carry over into 2014. And I'll probably be doing, I usually try to do this every year. I try to do like a New Year's resolution because, of course, January 1st brings on all the resolutions from people. I have personal ones, I have trading ones, and I'll share those with you as I try to do. I think one of my best resolutions ever was probably like 2010, I think it was, or 2011, and there was times where I would like sometimes break my keyboard if I had a really crappy trade and or break my mouse or something like that. And it was because there was an area of emotion there, and I didn't feel like it ever affected my trade in the sense that I became overly emotional in my trading, but it was enough to where I said, I don't need that in my trading. I don't need to have that. I don't need to let stocks from time to time have that effect on me. So I weeded that out, and I haven't broken a keyboard or broken a mouse since then. So, uh, but there's things like small things like that that can make positive outcomes in your trading in the future. That was one of them for me. And this year, we had a very, I guess you would say, a smooth year. I think 10 out of the 12 months we finished in the green on the S&P. Um, and we had very few weeks where we actually finished down. And if we did, it was usually bought up right away with a dip. There was no sustained pullback in the markets. I would say, just off the top of my head, we probably like the biggest pullback we saw the entire year was maybe 4 or 5% max. Um, so we got today, right, coming out with 15 points to the downside. Has traders probably on edge a little bit, wondering, okay, is this a sign of things to come for 2014? We'll say this, and it really varies by the person. Some people say as January goes, so goes the rest of the year. Some people say as the first of the year, or as the first week of the year goes, so goes the rest of the year. Some people are really aggressive and say as the first day of the year goes, so goes the rest of the year. So if we're going by the first day of the year, of course, right now doesn't bode well for the rest of the year. As the first week goes, that's yet to be written. And then as the rest of the month goes, of course, we're in the early stages of that as well. December, we started off very, very negative. And if you remember, I think we were down about 1.5, 1.9%, and then we rallied quite impressively to finish at all-time highs for the year. So just because of what we're getting today doesn't really mean much in terms of where the month will end. If I had to say, I'd say probably if you're going to buy into the school of thought that January has a profound effect on the course of the markets throughout the rest of the year, I'd probably go off of the month, but I think the week too can sometimes give you a good idea as well. The last 3 years, the first week of January has been up. The last 3 years, the markets have been up. So that gives you an idea right there. Now, if you look at January of 2009, I think we were down quite a bit because we were still in that huge sell-off, and we didn't bottom until March, but yet the market finished up on the year. So it's not a foolproof kind of thing. It's one of those things that, you know, has its moments in the sun, and other times it doesn't. So the S&P, most notable thing that we're seeing out of it today is it's testing the 10-day moving average. And I don't think that the 10-day moving average, if it breaks below it, automatically means sell, go short on everything you can find. I don't look at it from that perspective. I look at it as more of a reference point where dip buyers do tend to want to buy into stocks at that particular level. A lot of times when the markets have a sudden pullback, dip buyers will come in and try to get stocks on the cheap and then push it back higher. Sometimes before the market even closes, it will have a dramatic rally, maybe not wiping away all the day's losses, but a good, you know, half of those losses. You know, halfway through the day right now, that's yet to be figured out, but that's a reference point. So right now we're actually seeing the slightest bounce, and I don't even think it's a bullish bounce quite yet. I mean, we need to break. If you look in this upper left-hand chart here, we really need to break back above 1839 to really confirm whether or not the bulls are going to buy this dip or not. Right now, it kind of looks like a bear flag, so I wouldn't be getting excited. By no means. And I'm not even buying anything right now on the day. I mean, there was a lot of setups coming in today that I liked. I'm not buying anything. I'm not even considering anything right now because the markets don't support any reason to get long at this point. Now, if we get above 1839, I'm pretty sure you can count on me wanting to get long on some stocks. But right now, that's not the case. So 10-day moving average, great place. You know, in the past year where the dip buyers have wanted to buy up the market. So watch that indicator to see if that proves true again. And then, you know, if we have a dramatic sell-off over the course of the next week or so, 1809 really needs to hold. It's a breakout level that this market saw back on late December or mid-December. It was, you know, on December 18th when the Fed announcement came out, markets broke out decisively higher. So we need to hold that. So if we pull back, we need to hit it and then bounce. If anything short of that will get me very nervous about this market. But right now, I think that, you know, there's a possibility for a more sustained pullback. You know, 24, 25 points without really causing much damage to the daily chart. So there's no reason for me to get short at this point. I don't have any desire to do so, and I don't think the charts warrant that. So if we break below 1809, I'll probably start, you know, adding a little bit more aggressively to the short side. Maybe not become net short per se, but have a short interest nonetheless. And if we break below this rising trend line, which currently sits at 1789 or so, it's maybe about 1791. But if we break below that, then that might be a good reason as well to go ahead and get short on this market in a more aggressive manner. All right, let's see. Let's check out a couple of mainstream charts here. Apple, double top in this chart. Not really liking what I'm seeing right now on it. I think you're going to see this 539.40 level become a pivotal point for the stock. Not only does it mark the lows on this double top formation, double top being, you know, one peak followed by a second peak of the same price level, but you also got a high from the previous highs that, you know, mark like 536. Is that what it is? Yeah, 536, and then the lows here was 538.80. So when it's a stock trading, you know, well over $100, and in this case $550+, you got to have a little bit of variance. You're not going to have it right on the same dollar or the same penny. So in this case, you know, $2-3 difference between the previous highs from late October to the lows from December. A couple of dollars difference isn't that big of a deal. It's negligible. So Apple, I would stay, you know, bearish on it at this point. Google, trading over 1,000, trading over 1,100 actually. the chart still looks like it's fine and intact. It could be another breakout candidate above 1121. And you got a good trend line going. So I think everything is still intact. It's a much more bullish chart than what you're seeing out of Apple. Google looks very solid. You got some products that are going to be hitting the public later this year with Google Glass. Huge, big wild card right there. Nobody knows how much the public's going to like it, accept it, jump all over it. Could it, be the new? Could it have the same impact on the smart technology as the Apple iPhone had? I don't know, and we'll find out that later in the year. And then let's look at one of the bigger stories in the market this year. Not Twitter, but Tesla. Twitter will be next. I'm still feeling bearish towards this stock as well. You can see that there is some price resistance overhead that it's having some difficulty breaking through. You can see this was a price level that's been marked many times below either as support or as resistance. And just recently on the 26th, it was marked as resistance. So I would say there's more catalyst or more reason to be bearish on Tesla going forward than there is to be bullish. And finally, let's look at Twitter. And this is hard, man. Really, a lot of people claim to be, experts when analyzing the stock. I find it somewhat difficult to analyze this stock because there's just such limited price data. We're going back to basically about November when it came out, and there's just not a lot of price action. But if you want me to dissect it anyways, I'd say it has a broken trend line here. It started rising in early December. It went from 40 to 74, practically a double. And then it just dropped off hard. And while we might have bounced over the last 2 days, I don't see it reclaiming that trend line quite yet. So as a result, that trend line is still acting as rising resistance, and probably the catalyst or there's more reason to be bearish on Twitter going forward than bullish. So I've done about 4 mainstream stocks, right? Apple, Google, Tesla, and Twitter. Out of those 4, one of them looks bullish. 3 of them look bearish, and Google's the only one that has positive vibes going forward. So those are 4 very popular, highly traded stocks, and they don't look that great right now, even though the market closed just on Tuesday at all-time highs. Well, that's going to do it for today. If you guys have any questions, feel free to hit me up at ryan@sharepointer.com, or if you're a subscriber, I'm always in the chat room. During the trading sessions, feel free to ask me any questions, any concerns, any thoughts, any questions you might have about stocks in general or a particular stock. I'm here. I'm at your disposal. And I hope you guys all have a great 2014, a great year ahead. And I hope it goes just beyond a successful trading, or personal lives, and with family, and with your own resolutions, that they would all turn out well for you. That's going to do it. Thank you, and God bless.